You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
Welcome to Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by CBOE Live Vol. CBOE Live Vol is the leader in equity and index options trading technology, providing professional and retail traders with the most sophisticated options risk analysis, compliance, and trading tools. CBOE Live Vol offers a broad spectrum of advanced trading technology, including the Live Vol X, next generation execution platform, and Live Vol Pro, the new standard in options trading front ends. Visit livevol.com for a 15-day free trial today. And by Russell Investments, the home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now, it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
Welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from a little thing we like to call the old Options Insider Radio Network. Produce a wide array of fun content for you guys to enjoy on said network. Best place to find that, of course, the mothership, the flagship, theoptionsinsider.com. While you're there, click on the Insider Radio Network tab, top left corner of the page, and your audio adventure has begun. Of course, also iTunes, TuneIn, Stitcher, and so on and so forth. Pretty much wherever you find your favorite podcast programs, we're there, including soon to be Google Play podcasts. Whenever they get that platform launched, will be there as well. So an additional place to find it. And of course, if none of those work for you, you can always just grab our mobile app, available for iOS, Android, and the ever popular, ever exciting, ever growing Fire OS. And if we sound a little bit different this episode, it's because we're coming to you on location live from the CBOE Risk Management Conference here in, I always say scenic and sunny Florida, but it actually is scenic and sunny where we are right now, Bonita Springs, Florida. But the conference just wrapped up. If you've been listening to our network, you know we put out a stream of conversations and interviews from the conference all week long, and it's all kind of culminating here. Like we said, the final sessions just wrapped up, so we have the conference very fresh in our minds still. And I'm joined to discuss a very special episode here of Vol Views, going to dispense with the usual format to kind of do a deep dive into all things we learned and perhaps some surprises here at RMC. And joining me to do just that, first off, I am joined by the greasy meatball himself, Mr. Mark Sebastian. Mark, we don't have to play Where's the Meatball this week because you're right here in front of me across the table.
Indeed, although to be honest, it's been nice to be at this conference and not one person has called me the greasy meatball.
That'll change.
Which has been nice.
That'll change forthwith, sir. So, and we'll also be joined in a little bit by Mr. Corner Office himself, Mr. Russell Rhodes, or Dr. Vicks, or whatever he's going to be called once he gets his PhD over there. He'll be joining us soon as well to give us his takeaways from all things RMC. So without further ado, let's dive right on into our Volatility Viewpoint segment.
It's time to welcome thought leaders from throughout the volatility trading world. It's time for Volatility Viewpoint.
All right, everybody, welcome to Volatility Viewpoint. This is usually the portion of the show we welcome on a guest from throughout the world of options and derivatives and volatility and trading and proceed to pick their brains for your benefits. Today we're going to do it ourselves and kind of give you our take on the show. Mark, it was an interesting 3 days here. We're wrapping up here on Wednesday. The show started on Monday. And it's been, I'm not sure how many of these events you've been to. There seems to have been a market evolution in this event over the years that I've been coming. This is at least my third, if not more. I usually do every other year, so it's been like 6 years or so. Essentially, when I first started coming to RMC, it seemed like it was very much bifurcated, very much almost aimed at two audiences. The first day or so, day and a half, was very much what's a call, what's a put, for those managers out there who really hadn't wrapped their heads around this stuff. Yeah, it was kind of like a slow entreaty to them to kind of come on board from an options perspective. And then it started to evolve with different stuff. Then it got really deep dives into, the VIX call, SPX put. Still had some of that this year, but not as much. And then this year they seem to really shake it up a bit again this year. New presenters, new topics. It wasn't all, VIX versus SPX. So again, there was some of that. There was a lot of disparate topics on the docket this year, including taxes and a lot of other things you haven't really
directional
considered.
Trading.
Yeah, directional trading. And it was very much aimed at, I think, an audience that was already, in the choir, in the wheelhouse, if you will. They already have some knowledge, some wherewithal of options, so they weren't starting from scratch. They weren't starting fresh.
No, I mean, I basically, it was assumed when you came here that you understand the P&L payouts of buying a call and buying a put, and vice versa. But maybe you weren't as clear on some of the P&L characteristics of being short volatility, short premium. So I think you could look at each of the days as very separate days from one another. There really was never kind of the beginner. Last year
there was no what's a call, what's a put day.
Yeah, and last year they did what's VIX, and they didn't even do that this year. But what they did do is, this is what selling a put is, and then they did another one on this is selling a put, and then they did a final one on this is selling a put.
You're stealing one of my key takeaways from the show. We're going to get to those in a few minutes. Order of the day.
Order of the day, day one was put selling. I thought most notably, the most interesting presentation for me was they had John Marshall from Goldman Sachs and Zem Sternberg from Lake Hill. And they did a discussion about put selling versus bond ownership in high-grade corporates, obviously not the same as government. And John Marshall in particular had this thing he called the bond buyer's equity basket.
Yeah. He also liked free cash flow yield a lot.
The free cash flow yield was interesting, and I think that's valuable. So their first point was the number one reason that they like to buy a stock, or they think one of the number one determinants of the success of a stock in terms of overall market outperformance is free cash flow yield. So how much cash is being produced. And then he took it a step further and then pointed out bond sales put sales and how that could work. Now, the one thing that was interesting is it's the bond buyer's equity basket, and he kind of puts together a series of long equity and short puts. And, if you look at the returns from the bonds, the corporate bonds, I think, returned 5% with a volatility of 5% and a drawdown of 3.4% since the inception of this basket, which was in November 2012. So, it's a interesting set of, so be aware of the sample set.
It's not all the way from 1987.
It's a 4-year sample set. So, it has August in there. Then the piece that I thought was interesting is their basket of equities does outperform the S&P 500. The puts sold against that basket, that was where things were really interesting. It actually had a smaller drawdown, similar volatility, and returned 16% instead of 5%. And yet the basket still owns equities. I actually pulled John aside, after the fact and said, well, why
mess around with that component?
Yeah, why have the equity component at all? And he said, well, it kind of is in line with what our customers are doing. It makes sense. Most of them don't, want to have some sort of ownership aligned with the puts that we're selling. and so that there's upside. And so basically, they don't want to do total stock replacement with short puts. They want to catch upside. I then asked, well, why not own calls? And he said, well, we want to maximize income. I said, fine. So that was really fascinating on day one, and one of the things that I really enjoyed. The other ones, the intersection between macroeconomics was kind of neat. The Stacy Gilbert of Susquehanna, great, smart. It's nice to have like a true, straight up market maker.
There's a different perspective when they get on the stage.
And her analysis that Susquehanna thinks there's, based on kind of where skew is and where things are distributed, that a touch of 1700 at about a true break below 1700 had a 30% odds, and a touch had about 60% odds. I thought that was really unique, and obviously we just got a lot smarter in the room because Russell Rhodes just joined us.
Is Steve Hawkins walking? I missed him. But no, that noise, listeners, we are joined, better late than never, by soon-to-be Dr. Vicks once he ever gets that degree finished, Mr. Russell Rhodes. Russell, you've been front and center for pretty much every presentation except for the ones, obviously, where there were 2 tracks. So there was a lot going on this week. Mark and I were kind of just giving our kind of 10,000 foot perspective. But we were just starting off with day one. So that's pretty much where we are right now. Maybe before we even get to day by day, he kind of stole my one of my themes, one of my takeaways from the conference, which is sell puts and sell them often. There was so much data, not just during the conference, of course, before the conference with all the studies that came out, the weekly put right versus the monthly put right, the Russell weekly versus monthly. We had Mark Shore on this network talking about a study just a few days ago.
The leverage put right.
Leverage put right. Then coming into the conference and more sessions. You mentioned the Goldman session and others about put writing. So was that your key takeaway as well? Is that just write puts and write them often, sir, and you will have a smile on your face?
Well, it's interesting. It's not necessarily write puts. It's more about selling options, because I think when I walked in, you guys were talking about the where they broke out the performance of a covered call strategy, and I said it's basically all about volatility and very little about price performance. So that's selling calls. The leverage put right didn't get a lot of love here, but he doesn't know it yet. Mark Shore and I are sharing a cab to the airport, and he's getting ready to learn about leveraged put rights and see if maybe we can get him on board with doing a little work on what Mark, Sebastian, and I have done in the past, looking at leveraging up some of these strategy indexes that CBOE has.
There was an ETF guy that I was talking to that trades all leveraged ETFs, and he was like, wait a minute, I can lever this put right strategy? He was like, ooh, that sounds yummy. I said, it should sound yummy.
Yeah. Why sell one when you can sell 6?
Yeah. Right.
So, and you could do it a leveraged where it matches the daily performance, and then all of a sudden you get all this slippage, and who keeps that extra?
Exactly.
Yeah.
So, it's been a lot to chew on. I'll let you mull over a little bit. Mark, you were just kind of running down your takeaways from day one. Continue, sir.
Yeah, I mean, to Russell's point, I think an interesting piece was the first presentation by AQR, where they really discussed how the timing portion of covered calls is really what is the value killer and adds the most relative volatility for almost no return. And that was interesting to watch. Mark Shore was the other one discussing all of his pieces on Russell overwriting. It was really across the board. Of the ones that it was the least kind of, I think, quantitative, but maybe the most valuable to people like myself. Zem got on and did kind of really talked about the approach to actually talking to people about put writing and option writing and how this stuff works, and being able to sit down with the asset manager or the pension fund that has their arms crossed and thinks this stuff is risky, and then gets them into kind of really understanding that maybe it's not such a bad idea, and that risk adjusted there is some value. That the really panel after panel on day one. Yes, it was the same. It was similar topics, but the each had a little twist on it that was absolutely worth listening to.
Yeah, I missed the beginning there with Zem and his approach, but that's something they did last time I was at the conference as well. They had more of the getting past the consultant stage, getting in through past the door.
Yeah.
The gatekeepers, which are still a huge problem for a lot of the people who attend this conference. They want to utilize these strategies. They see the efficacy of them in all these different studies, and yet you're right. They go to the consultant, and it's like arms crossed, no thank you. So some of the practical side of that, I think, has definitely had some utility at this conference.
I do think that's getting a little bit better. There was a question, one of the second or third questions for the panel that we're talking about was, what kind of pushback do you get from your board? And I think there were 4 panelists, and I expected 3 of the 4 panelists to say, well, our board really is skeptical, or they keep a close eye, and I think 3 of the 4 panelists said, our board has become sophisticated and they understand what we're trying to do. And I thought one of the best statements was, success begets success. So, successfully implementing derivative strategies that have enhanced performance, opens the board up to allowing more of that.
That was the panel you're alluding to was one of my favorites as well. I believe that was day 2. That was with kind of the consultants there from the Pension Consulting Alliance, I believe, as well as 4 different pension fund representatives or elements therein, and kind of getting their perspective, because they're the ones a lot of people want to bring to the party. And if they're not welcoming of this information or anything like that, that's a huge problem for pretty much everyone who attends here. And so to see that they were moderately conversant on the topic for the most part. They were talking about selling straddles. They were talking about a lot of these strategies were pretty basic, but that's in and of itself a huge selling point. You don't need these guys out there talking about slinging 1x3 iron condor swaps or things like that. They need to have a firm understanding of the efficacy of the basics, because then they have to turn around and sell it to their boards too. And if you're doing something crazy and esoteric, chances are the board's not going to have a lot of buy-in to it. And there were a lot of great takeaways from that panel, I thought. Not just that they were more accepting of some of these strategies, but they made some great points like you can't, and trying to convince these guys to test it on more than just 2%. I thought that was a great quote. You can't just come in and say, okay, I believe in buy rights, or I believe in selling puts or collars, or whatever the strategy is they want to use, and then just put it on a 2% alts allocation and expect it to have any sort of efficacy or value added. It has to be at least 10 to 20%. And you actually mentioned some of the clients he's working with getting in there of the 50% of their equity allocation and utilizing simple things like hedging and collars and strategies. So he's starting to see, at least from his business perspective, a little bit more buy-in, literally and figuratively, in that perspective, from people actually coming to the table and saying we want to use these strategies.
Although what was interesting, I thought, was how much these guys do some of that in-house. I was really surprised.
Yeah, that surprised me too.
That they moved toward in-house. I also noted that of the speakers on this panel, there was the only one that said, no, we have not used any VIX stuff yet, was the one that's actually located in the state of Illinois, of course.
Why would he? It's like right down the street from him. It'd be too
it was what, 2 Texans, somebody from Wisconsin and Illinois.
Yeah.
The Texans, you could see that maybe Wisconsin's changed a little bit over time, but Illinois is what it is still, I guess.
It was the Texans.
They actually have money in the Texas and Wisconsin pensions.
Interesting. When Texans hedge, they actually hedge themselves.
You can't buy VIX on a zero portfolio of the Illinois pension. But there were some interesting quotes coming out of that too. One of the, I think it was a Texas guy, or one of the 2 Texas guys, recommended. He was looking at TY VIX, and you hear a pension fund manager looking at things that are relatively far afield like that was pretty interesting. Talking about risk reversals, how they like to utilize risk reversals and all that blew my mind. I was like, wow, these guys are coming in and using risk reversals. I mean, some of us, sometimes we're so deep in the weeds of the Chicago options trading world that we think everyone thinks that way, and we come to some of these things like this, we get a little bit outside the bubble, and it's kind of refreshing to see some of these other guys who are now starting to come to the
in the last panel that I was at was all about kind of global macro risk and global macro volatility. And the guy was covering knock-ins, knockouts, and Korean options. And somebody asked him, well, now that the banks aren't doing this, is there going to be a liquidity problem, or has this become less popular? And the guy said, well, believe it or not, a lot of the endowments and pension funds are taking these things down. And I was like, okay, well, there you have it. So it was a really fascinating discussion of cross-region volatility analysis. And the thought of Texas teachers trading, Nikkei knock-ins was really a surprise to me.
Russell, you and I were talking before we came in about some of the other topics that maybe aren't as sexy, but are still pretty important. Like I didn't get a chance to sit in on the taxes panel, but you did. What was your takeaway from that one?
The taxes panel was pretty interesting in that they brought up some things that we expected, which was that the SPX options are 1256 contracts. You get for shorter term gains, you get benefits. But one of the interesting things was it was noted that if you get involved in a structured product that is basically backed by SPX options and a systematic SPX option strategy, your tax rate is higher. So why not consider doing something like that on your own, where instead of paying 40%, I think you're paying close to 30% or so, depending on your bracket and the 60-40 split and that sort of thing. But I found that pretty interesting because when you think of taxes, you just think of, okay, what strategies, what are strategies costing me? But an alternative to a different payout that has a tax advantage, that's something you normally think of within fixed income and not necessarily in the option area.
Yeah, and that's kind of a takeaway we can take from kind of all of these sessions too. I mean, all of our shows in general is that usually 9 times out of 10 you're going to be better suited doing the strategy yourself than paying some exorbitant fee to have some structured product, try to replicate it, and probably not do as good of a job.
Well, and to go back to what Mark Sebastian was talking about, where he said he was surprised that the hedge fund, that the pension funds were doing the hedge fund type things in-house. Well, I know he wasn't in a presentation that I was in about tail risk at the end of the second day, but one of the speakers actually started out, and he said, when you're using a hedge fund, you get 80% of the upside and 100% of the downside. And I think a lot of the pension funds are seeing that sort of thing. I think what becomes difficult is if we get into a competitive environment where talent that knows how to do those things is being pulled away, then they're going to have to make some sort of difficult decision as far as compensation goes. And I think it's probably a tough sell sometimes to have a guy working at a teacher's retirement system making more than the governor.
Yeah.
Yes, that's very difficult. That's a difficult sell sometimes.
That's come up a few times at some pension. Exactly.
Yeah. Another thing that I thought was kind of interesting, we have one of the panels was on differentiating and benchmarking volatility-based investment strategies. So we're kind of getting in day 2. Day 2, there was some really cool stuff. The first panel was, this Ben Lonergan, who we interviewed, was the CEO of, or the senior executive managing director.
It's a very dense title.
Convergex, blah, blah, blah. And after the show, we were talking about that panel. He said that's the reason why everybody's here. They are the top of the food chain. They are what creates every other job here. And so it's really fascinating to get to listen to them. And that was, what do institutional asset owners want? And then second panel was on benchmarking and doing portfolio management for those asset managers. And the other guy that we interviewed, Santoshi Iwanaga, I said his name probably 4 times before I got it right on the first interview. Iwanaga, the fact that 11 of the 12 months last year, CTAs got the CTA and commodity pools got the number 1 allocation of all hedge fund things that fall under their hedge funds, I thought was absolutely shocking.
Not surprising given the love for crude these days and just the interest in it. And then gold lately, those products have kind of been dominating a lot of the headline. It makes sense. Maybe not win every time, but it makes sense they would at least be up there,
Yeah. And then, one of the pieces they're doing along with CBOE option-based strategies that I think will be in VIX-based strategies that I think is going to really be excellent. And there were some interesting thoughts out of there. And how they view. We actually had opposing views. You had, on one hand, you had a guy saying, no, you need to have your tail risk on all the time, and you can't just go out and buy a put. And on the other hand, we had our friend James Catullus, who works with Typhon, saying you can go out and get vol when you need it. So it's really fascinating to see 2 large asset managers having completely conflicting views of the marketplace.
Well, interesting. Go ahead, Russell.
I was just saying that's typical of this year's conference relative to a lot of other years' conferences is the divergent of views and the wide variety of different. People like to talk about their favorite trade or their favorite strategy, and 2-3 years ago it was short volatility, short volatility, short volatility. Now it's a mixture. It's directionally long for stocks. How do you lock in volatility and negate any price exposure? I even saw somebody talk about. I saw a presentation on buying a straddle into earnings of all things. There's no overriding theme, and a divergent opinion from similar types of managers on a panel like that. I think that's indicative of what was kind of great about this year.
That was good. It was a lot of divergent thoughts. I think that panel was kind of interesting. Caught my eye as well because you kind of have two different perspectives there. You have the Typhon guys who are kind of trading the curve all day long, so they're kind of right in that perspective. They can get the vol whenever they need it because they're watching it day to day. Versus the tail risk guy who's kind of putting it on ahead of time, and he's right too because if he doesn't do that and then he tries to go to get it when he needs it, it's going to be a hell of a lot more expensive. He's not going to want it anymore. So I think they're both kind of right in that same scenario. Kind of interesting stuff. Some great quotes came out of that session as well, like the guy who said, I think it was the Harvest guy who used to be the former SPX guy who said nothing like a 50% drawdown in the equity markets to get people to change their minds on options. And that's completely true.
It's totally true.
And that's kind of the biggest selling point for everyone here at this conference. They're kind of probably secretly praying for another Six Sigma event to the downside to show the efficacy of some of these strategies.
Yeah, and then it was kind of neat. They had the keynote was interesting and kind of outside of the box, and then we had these two great panels in the afternoon. And this was nice. They split off things into tracks. I don't recall them. Did they do that? They did do that last year. But the tracks were really unique, and the one that we got to listen to Dominic Salvino, who's the VIX specialist, got to get up and talk. I missed him he did not speak last year. And
he's the other guy who buys with you for the Dr. Vix title there, Russell. You two go back.
Except for he's not completed his.
And he's the godfather of VIX.
That's true.
He's the godfather of VIX, and he's never going to complete his dissertation.
Oh, well, there you go.
So whereas Russell will. So it'll be Dr. Vix and
it's a race to the dissertation.
And it'll say and PhD less dissertation Vix Salvino. And then they had Art Liu and Joe Aiken, and Joe Aiken kind of walked through how he quietly, basically how he made a blasted killing when TVIX dislocated back a couple of years back. We had a nice long vol views conversation about that.
We had many on that.
Yeah, it was basically he basically said, "This is how I arbed," and it's probably never going to happen again. So enjoy that. And Art Liu from Citigroup kind of talked about how he works with clients that are looking to do capture roll premium, capture risk premium out of things like VXX and XIV. And what was interesting is he kind of discussed that even though the VIX futures are in contango maybe more than 75% of the time, you really only can capture volatility premium in VXX about 63% of the time. So people look at that nasty curve and they think, biggest layup in history. Does it historically make money? Yes, but it's not as simple. And so Citigroup's actually developed what he calls, I'm driving on the highway, I've slammed on the gas, I'm going as fast as I can. Oh, I see something ahead, I'm going to back off and maybe stop accelerating. And then, now that I see what's directly in front of me, I know to get off the gas. So it was really neat seeing these guys discuss how they view VIX ETPs and VIX itself. Dominic talked about the VIX weekly options that you said they're doing great, and the weekly futures, and this is something I did not know. If you're wondering, the options took off, why isn't the futures quite caught up yet? And lo and behold, OCC margining. Mm.
Oh. It's still always in the details.
Yeah, they've not. You don't get perfect margin relief when you own a 1 month future versus another month future in the OCC, but you do get some relief. Like they recognize that if that front month future goes to 40, the next month out is not going to be sitting at 15. All right, there's some relief there. And right now, the weeklies are relative to each other and to the big contracts. It sounds like they've not figured out the what the margin is relief should properly be on those things. So that's been one of the problems with that. But that was that panel was the first taste of the mathlete marathon that took place today.
Yes, there was. If anyone who had the over/under on when the calculus equations would come up on the board, it was today, definitely.
Yeah.
And maybe I missed that panel.
It took till about 4 o'clock in the afternoon to get a lot of serious math. Although the AQGAR guys threw some stuff in, and but it wasn't until that one that they really slammed you with their math.
It wouldn't be RMC if there wasn't a little bit of calculus on the whiteboard at some point.
Well, today they got into linear algebra.
Today they went hardcore in the session I was in this morning. We'll get to that in a minute. It was all about deriving some of his principles towards the end. I think it was Ilian from Wallachbeth who had the denser portion of the show. Before we get into that, thinking back to yesterday, kind of the session that caught my eye, because there always has to be somewhere in the mix someone who breaks down the latest iterations on VIX call versus SPX put. And this year it was in the second panel. I think it was the same time they were doing the VIX. I was in the other one, and that was when they were breaking down some of these strategies. And I always love the different leaps they go to try to make one outperform versus the other. And it seems like, and maybe you guys have different opinions, and all the time I've been coming down here, it seems like it breaks down into a couple of different strategies that you have to really use to make the VIX call really be the winner in that scenario. Because if you just do it straight up, we talked many times on this show, VIX is not going to do well except for those moments when it does really well. Yeah. Then you want to be in there. And so how do you maximize that? We talked about it many times on this show over the past year. One of the strategies, I forget the woman's name, who outlined, I think she was from UBS. Rebecca, yes, she outlined one of our favorite strategies here, which is the short vertical, the short 1/2 ratio. Yeah, we saw that done for size last year in the marketplace.
She's actually shying away from that now.
She started to have an evolution. But I mean, we talked about how many times last year that was the number one largest size trade going up for many months until about August when he hit it out of the park and he stopped rolling. He was rolling every month about 1 million contracts of that short 1/2, and lo and behold, it worked. When it worked, it did. And then we can get to that, Mark, and we'll get to the second iteration she mentioned there as well.
The second guy actually in the VIX one with Dom, he did a big analysis on SPX versus VIX, and what he really found was that if you're hedging a lot of the times, if you're hedging very near dated, so we're talking front month, the SPX is going to outperform if you're just buying the SPX versus just buying VIX. The way you make VIX more effective is when the option goes $5 in the money, take your profits. He said it's far more effective. Then he noted, and this was actually kind of fascinating, that that scenario flips if you go to a spread. The VIX call spread tends to not get capped out the same way an SPX put spread does. And so if you're hedging with VIX call spreads, the relationship flips, and you're actually far better off hedging using a VIX call spread as opposed to a put vertical.
Yeah, and I think Rebecca kind of made that point too as well, because she said it wasn't. She had another strategy, and she said that kind of the 1/2 was very effective in certain times, particularly getting into the August regime, not just for the underlying movement, but the backwardation is really working in your favor. Of course, it works well towards the VIX options, where the SPX puts are still decaying with the theta, and the theta is hurting you there versus the VIX call. She mentioned it about 6-month period, which is probably dovetails right when our friend was rolling for a lot of size throughout the year, that 6-month period last year when that short 1/2 was extremely effective. And the other strategy I've seen outlined in previous years, and she brought up later, her kind of second iteration of the strategy she likes is the VIX calendar. That seems to be the other way people like to make VIX work out. And the terms vary depending on who you talk to. I think a lot of them settle around the 3 months. That's kind of what she had up there as well. I forget the percent out of the money she was going for, but she had about a 3-month VIX calendar, and the way that worked out, particularly in certain areas of the term structure, is kind of her other go-to to make VIX being the more effective.
Which leads us right into the first presentation from today, which was scary and fascinating at the same time.
Scary and fascinating. You sum up all of RMC that way, kind of. Scary and fascinating.
Manish gave some really interesting stuff. Then Sam Vasquez from Quant Strategies at Capstone, he basically pointed out that 2 things are going on. Term structure is flattening, and he thinks it's directly related to XIV and VXX. I can't really make much of an argument with that, but it is flattening. And then 2, that VIX term structure correlation is increasing. So VIX VIX correlation to the SPX the last year is the highest it's ever been. So the VIX anti-correlation is you and I would say a word like negative correlation. Of course, they've got to call it anti-correlation. So VIX anti-correlation was over 90% the last year, which is, and he said it's starting to turn into, an XIV is starting to turn into S&P 500 exposure, which is, not a good thing if you want to trade volatility.
No, not looking to hedge it with that product. No.
I mean,
it always has been to some degree. But.
Well, yeah, I've always what I refer to it as, and it hadn't caught on, but there's this delta component to the VIX derivatives, and it's the price change in the S&P 500. And then, maybe we need to come up with a third derivative Greek that talks about how quickly we get that price change out of the S&P 500.
Yeah.
And that's what makes VIX.
That can be your dissertation right there. Yeah. There you go, Dr. VIX.
There you go. No, but somebody's going to steal it. I just said it on that.
But the piece of
we'll mute that part out. We'll edit that part out.
I thought the piece of term structure moving more uniformly and flattening. It makes some sense that term structure flattening because of what the market does. But Russell, what did you think about his observations that the entire curve is seeming to move together? I talked to Dom briefly about it after the fact, and he goes, maybe it makes sense to be long the front and short the back. And
spot on impersonation, sir.
Hey, I took a look at a while back. I was like, instead of doing VXX as a hedge, every month, buy the front month, sell the second month, and then just continue to roll it. And it doesn't work particularly well, but one of the things that Rebecca talked about was, hedges and how long does it take for you to draw down.
That was interesting. That was really interesting. Yeah, she got some pushback on that in the audience. Like, why are you rolling to at the 1 month period when she was just talking about which all of her rolls she was rolling at that period.
I know what she was doing, and she kind of glossed over it with that because I got a question about that as well. But yeah, she got pushback on talking about how much the hedging costs relative to what you would have made in 2008. But I think that's an interesting way to look at it. With respect to rolling when she rolls, she said something that I don't think anybody caught on to. But she said she rolls, but she still ends up having some free calls. So she's not rolling the whole position. So, and what she's doing is and I talked to a manager this morning that does similar things to her, and he said, that's not systematic because you've got this window where you could get creamed. I said, yeah, but I think she's got some calls that she's still holding. And at that point, they may have made a little bit of a profit off of the hedge that they had on, or enough to pay for those calls. And I think that's what she was doing, but she said it very quickly.
Yeah, she didn't.
It didn't show
really,
that part,
yeah.
but I heard her say that. She goes, and when we roll, we end up with some free calls, and then she just kept going.
That would make more sense.
It makes a lot more sense.
People who are pushing back on that were saying, well, I understand theoretically why she would do it, but also when you roll away from that 1 month period, you're missing, and some people brought this up, you're missing that point of maximum sensitivity.
Yeah.
So you kind of want to be there for that.
Yeah.
And you're giving that up when you roll.
When Putin starts a war 3 days before
you want to be there in the front
months. Expiration. He went into Ukraine, and we had 2.5 weeks left to February expiration, and the futures moved like a point when VIX moved 5 points. Could you imagine if February had been the second month?
Yeah.
It might not have moved at all. It definitely would move less than a point. So, I think a lot of people were scratching their heads on that one, but then, maybe my solution is wrong, but that's what I think she said. That makes a lot more sense.
I like your version. I like the notion of having some free VIX calls.
Yeah.
That makes it a little more
it was
compelling.
funny. There is in every single presentation, somebody asked a question where the panelist or respondent would start smiling mid-question. Oh, yeah. And you knew what they were thinking. They were thinking, 1, I do know the answer to this, and 2, I'm not telling you. and you got it all the time.
Yeah.
I do want to back up to the last session to Rebecca's session, but to Ari from University of Chicago. he was probably the biggest proponent of having tail risk insurance out there all the time. Rebecca said systematic plus some sort of using your noggin makes sense, and I like that as well. But we had a whole panel saying they didn't want to waste money on tail risk, I think before or right after lunch. And then Ari said, if you've got tail risk protection on, there are a couple of great benefits. One, you don't lose your freaking mind when the market falls apart because you've got that there. And you're actually able to make logical decisions. And then the other end of it, and I really liked this one, is when you're talking about pensions and endowments, they by rule, they're supposed to cash out 5% every month to pay for something. That's just the way they get there. To maintain their status as an endowment, or I meant endowments at universities. Well, what happens when the market sells off like in 2008? The liquid assets are the ones that get hit the most. And you suddenly may have to sell some illiquid assets to stick with that mandate of 5%. Well, if you've got some sort of tail risk on and you monetize that, it allows you not to sell illiquid assets at the worst possible moment. So you hear tail risk was huge. I don't know, 7-8 years ago because of what we had just come out of. Now people have been spending money on it. They haven't benefited from it, so you start hearing negative things about it. I just like to hear Ari, who is a practitioner and is at a big endowment, explain why it's not a complete waste of money.
Yeah. It really isn't. And then the nice thing, and I think it's different, this would be a clear case where it's hard to make a case to outsource some of your tail risking. I mean, one, maybe paying a consultant, somebody to help you build it makes sense. But if you look at most tail risk funds, they charge on notional value hedged. And
smart way to do it.
It's a very smart way to do it. And they, on top of that, they create a drag against your portfolio. One of the things that we've talked about with the Typhon approach is that, yes, they're charging notional, but at least they're not creating a drag most of the time. Doing it in-house at a University of Chicago, I think that's a much stronger argument than giving 2 and 20 to a tail risk fund that's going to lose money 7.5 out of 8 years.
Particularly for a guy like Dak, I think you mentioned he was to be a market maker and things. So he has some facility, I would think, with the notion of tail risk. A couple of things I wanted to mention. First off, you mentioned kind of the mental factor of tail risk. And Ilya from Wallachbeth mentioned that when I was talking this week, too, on the show. There is that kind of unquantifiable but demonstrable impact where if you have tail risk versus where you don't, you can kind of swing for the fence a little bit more, be a little bit more aggressive if you know your downside is hedged versus if you're not, you may be a little bit more conservative in your allocation things. So there are hidden costs out there, opportunity costs, call them what you will, risk aversion factor, whatever you want to call it, that people don't think about when they don't factor into the tail risk. And speaking of the cost of tail risk, the one thing I already got some pushback on, and I kind of wanted to ask him a little bit about too, he put up a slide up there and it kind of went by quick. He was quantifying the cost for his tail risk at like 32 basis points.
Yep.
And I think everyone kind of said, whoa, first off, if you're getting tail risk for that, where can I get some? But and B, and to his credit, he was talking, they have this kind of basket, so they had like CDSs. It wasn't just straight up 5% out of the money SPX books or anything like that. There was more to it than that, so that could probably reduce his cost, but still, 32 basis points for any sort of real protection. I mean, when Rebecca asked, would you hedge if it was free? 32 basis points for most people is pretty much free at that point. Yeah. I need to dig into that number a little bit more and see where he's getting that.
My recollection on that number is it was the lower end of the cost, and they were talking about in a lower.
Yeah, it was like 30 to 60 basis points. 60 even 60
was a number that kind of stuck in.
Most people would jump at 60.
Yeah,
too.
Most people would.
Yeah,
you're talking. Most people think in the 2+% range or not more.
Seems to be a scary rule of thumb, and people hear that and then they stop listening.
Like who was it? I think it was we were talking about. It was Stacy who was talking about the cost of the annualized cost of tail risk puts at being about 8.8%. I think
that's what she said.
So that's a heck of a lot more than 30 or 60 basis.
I don't know what he's doing.
Maybe he's got some magic sauce.
I need to go dig in. He might be backspreading. Who knows?
Dude, it's University of Chicago. They're smart.
And the interesting thing is that tail risk is not getting cheaper; it's getting more expensive. Again, looking at some of the more into the weeds stuff, the guys that were looking at kind of cross assets across kind of worldwide, the way volatility moves is not the same in every country.
Oh no!
It is shocking. I mean, I now fully understand why vol rallies when the market rallies in Japan, which is not something you would think about, and why it falls. This is the crazy part. He's like, you're trading a variance swap where you're trading S&P versus Japan, and you're Texas hedged on the first move because vol drops, and when Japan drops, vol drops initially, and when the U.S. vol explodes. It will really screw with your head on the first trade if you're trading cross-asset variance.
You got to go to, I mean, I'm not, this sounds so promotional, but you got to go to the European and Asian risk management conferences because the tone is completely different. In fact, in the presentation that you're talking about was actually given at our Asian conference. That's why I chose to go to the other one. But it explains an awful lot when you look at some of the global volatility indexes and the behavior of those volatility indexes relative to the underlying markets and how it does vary from place to place.
Talk about being, in the bubble. We hear, we think nothing but SPX and SPX vol and VIX, and you get outside these shores a little bit, and there's a whole other world of volatility and factors driving that volatility that sometimes we take for granted a little bit. Speaking of Texas hedges, I wonder if those two representatives from the Texas pension funds, if they would take offense.
They would do that to that Texas hedge. Well, that's two Texas hedge jokes in one show.
There we go.
Yeah, the Texas hedgers are actually Texas hedging. That stuff was really fascinating as they were walking through the demonstration on all. It was interesting to see how these big international firms like Societe Generale look at these big, huge structured products because we don't trade a lot of structured products here in the United States on relative terms. The banks can. It's all pension funds can, and it totally changes the dynamics because they trade all over the place and in ginormous size in Asia. They almost don't trade here. And what I thought was kind of news is that they're getting more and more popular amongst the Europeans. And then what the guy said was it's a search for yield. Japan's had zero interest rates now well before Europe did. So the question is, eventually, are we going to end up getting structured products here? And
if we go negative, maybe there'll be a boom of structured products if we do indeed go negative, as they're hinting and threatening all these times.
Yeah, it'll change the nature of covered calls.
Yeah.
No, we ran past it, and I didn't get to chime in on it, but we're talking about the pension funds taking the other side of some of these volatility positions. That's the search for yield. They don't know where else to get it now. And they got to find it somewhere.
Yeah, I mean, that's kind of still even though they were talking on that pension fund panel about risk reversals and things, still the predominant use case is hedging and finding ways to pay for that hedge with the covered call or the put spread and things like that.
But Russell, here's kind of maybe it's a rhetorical, you don't have to answer if you don't want. But if you're a pension fund, if I'm a pension listener, somebody who has money with a pension fund, and I'm hearing that my fund is engaging in variance swaps, my question would be like, is that any less risky than your fund owning a bunch of governments or a bunch of high yield stuff with the 10-year at 1.6? I mean, look at what just happened to the J&K. Yeah. What do you want your fund doing? That actually might be a safer investment.
Mm-hmm. The pension fund, a lot of the pension fund or people that have exposure to the pension fund don't care because they've got defined payouts, especially when you're talking about a lot of the government funds. And they're not looking at it and questioning that because they're looking at what they're going to start getting paid when they pick their retirement date. So it's more on the professionals to try and figure out how to get the returns to match their liabilities. And I'm kind of thinking this one through. When they're trying to figure out how to match those liabilities, and the best thing they come up with is what most people consider a complex derivative strategy, and they take it to their board, and their board says, this is the only thing, is this what we got to do? Maybe that's one of the reasons they're giving in the way that they're giving in right now.
And of course, you have all the counterparty risk and liquidity risk and everything else going on with those variance swaps. I mean, they're still, for the most part, still quoted in some pretty damn esoteric fashions where,
So there you go. You've got pension funds that are short variance and short puts at the same time. Nothing bad can happen.
Nothing bad can happen.
Nothing to see here, folks.
Speaking of short and puts, we got to the final sessions today, and Ilya, who I talked to earlier this week from Wallachbeth, he had a presentation about kind of using trades and strategy, directional trading, which is something else they touched on previously, but not to, I don't think, this extent in previous RMC. So that was kind of interesting to see. Because a lot of the guys here still come from that. They want their long equity or whatever. They want to have some sort of directional component to what they're doing. So it makes sense they want to see these things. And he kind of broke down a few different regimes, talked about stock replacement, the efficacy there, which are things, we touched on the network in the past for all the various Greeks benefits and capital efficiency benefits you get from doing things like that versus long stock and some other things like that. And he got into some different regimes, things like covered calls and how they would perform or underperform in different things. The one thing I wish he hit on a little bit more, I'll have to ask him about this, because selling puts have been such a theme at the conference. I wish he had a lot more on that. I don't think he even touched on that. Maybe a little bit, one of his slides at the end with some of the regimes. He talked about condors. He talked about, like straight up VIX call and a few other things. I don't think there was just even a short SPX put in that equation. Mm-mm. I would like to see that one just because there has been so much other data to see how it performs or perhaps underperforms in different regimes. Might be a nice counterpoint to just the effusive put selling love we've seen over the past few days. So I'll have to mention that to him, see if he can maybe update his slides with a little bit of that. Very dense in the information he was presenting, but it was very interesting. He was also the one who I missed the other session, so he for me was the one who broke the over under on when would the dense calculations first and equations first come on the white page. He really went deep.
What he talked about, and it was pretty brief, but I really liked, was he talked about pair trading with, and I've got a stock pair trading background, so I always get all excited when people talk about that. But he talked about pair trading. He mentioned the energy ETF, and then he mentioned ExxonMobil, which is the quality within there. So if you've got a bearish outlook on energy, maybe you're thinking about buying a put on I guess it's XLE. Maybe you buy a put on XLE, but you sell a put on the quality name that you don't think is going to go down as much. And that approach because I've always been trying to come up with some effective ways to go about pair trading using options, and I hadn't heard anybody throw that approach out before. And if there's one thing that I'm going to work on when I get back on Monday, it's most definitely something around that, and not just with that ETF, but other ones that maybe have one dominant high quality name, and then taking a look at the relative performance in down markets there.
Yeah, that caught my eye as well. And as soon as he mentioned that, I immediately tweeted it because I was like, wow, someone's actually talking about options pairs trading. You hear equity pairs trading all day long, and for whatever reason, that hasn't spilled over into the options world to any great degree. So to get someone on stage at RMC, it was a brief amount of time, but he spent some time on it. That's right. More than we've ever seen before. So that in and of itself was pretty interesting. And then they wrapped up with Michael from Optimize Advisors there talking about starting off with kind of your plain vanilla earnings straddle, getting back to what we talked about many times on this show. Do they perform or underperform? I think he talked about Twitter, then getting into Disney in a little bit more detail, and then some ways like they use with the Trade Legs Optimize software to optimize that, given their volatility distribution in the past, and maybe over lever to the underside and things like that in different scenarios, and more effective way than just literally just buying a straddle going into earnings, which I think we all can pretty much buy into that.
What I liked about his presentation, and I got a chance to talk to him for about 10 or 15 minutes before they got going, and he is so not a media type person. You just
Michael?
Yeah.
Oh, he's awesome.
He's just a super nice guy. It's the first time I've gotten to spend more than a minute with him. He talked about a trade that he would never be able to talk about on CNBC, and it was buying the Disney straddle into earnings, but buying it 5 weeks out. And of course, that's so long term.
Too much of a lead time for them. Yeah, they want to know your pick for this afternoon. Yeah.
But I've been doing. I mean, we've mentioned in passing that I've been doing some work on that. Now I guess I have to start over and look at 4-week straddles and that sort of thing. I mean, I've gotten questions in the past if implied volatility is going to climb up into earnings. Why don't you just buy a straddle? And I looked at a few instances where you could buy a straddle 20 days out, and then where are you at earnings? And this was pre-weekly, so that's how long ago it was. But the time decay versus the increase in implied volatility just about was a wash.
Yeah,
I only did it in a handful of stocks. So he did say, and he did reiterate several times that there was a fundamental reason that they were looking at Disney. He was citing just some things with respect to ESPN that he thought might come to fruition around earnings that got them involved in it.
Yeah, I think, Russell, you make a good point. This is we'll step out of the weeds and into just normalcy for option traders. I always try and explain to people that with earnings straddles, just because the vol goes up doesn't mean the straddle goes up. Mm-hmm. What really that vol goes up, it kind of makes time stop. So 5 weeks out, it makes time stop. So 5 weeks out, we know, the market has a pretty good idea of what that straddle should be worth when you're looking at, ahead of earnings, and they're not going to let that part decay. And so the vol goes up to slow down the theta. And, that's all that really is. Now, we would be a little remiss if we didn't talk about the keynote speaker from today.
I missed that one. I was running around, so I'll let you guys run with that one. It was
Jim Vandehei from, who's the co-founder.
Politico, right?
From Politico. And he gave a very...
On VIX term structure, I'm assuming?
It was.
He used the word volatility.
There we go.
I think he knew where he was.
Yeah, so, it was interesting. He had some really clear takes. He believes much stronger that the outcome of who the nominees are going to be than is generally accepted in the media right now, is basically the one thing I gathered. And, that was kind of interesting. He took some interesting questions on who might be vice presidential candidates and some other things like that. I was tempted to ask him some questions about Politico itself, and then decided, let's not put him on the spot.
It's a good timing to have him on. I'm sure it wasn't. It wasn't unintentional to have him on the day after Super Tuesday, which was, of course, a big time. We're recording this right after post Super Tuesday, Super Wednesday, call it what you will, here, and a lot of interesting fallout. I'm sure we've talked about before. People have written in the questions about electoral volatility and things. Can you imagine any scenario that'll give us more election-oriented volatility than if somehow Sanders becomes the nominee, and then we have Trump, and they're neck and neck going into November? That's a recipe for earnings or election vol.
This is hilarious. He actually gave Hillary Clinton a better chance of dying between now and the election than Sanders being the nominee.
He said that I remember the numbers, and it's really funny. He said 98% chance she gets the nomination, 1% chance that she dies, or health issues.
Health issues.
0.5% Sanders beats her, 0.5% she gets indicted. That was the
other piece.
Yeah, which I thought I found when he said 98%, I thought he was going to say 2% indicted.
Yeah, it was interesting. Yeah. So
that's hilarious.
That's his interpretation. Then on the other side, he gave. I was surprised by this. He gave Trump 80 to 90% chance of catching the Republican nomination.
Well, yeah, he's up there now. I mean,
but I think even I thought it was well over 50-50, but I did not think it was near 90%.
He said it's basically Trump Clinton at this point.
Did he mention any probabilities of our Bill Gup friend jumping in from outside as an independent, anything like that?
Bloomberg, we did talk about that. He said it's not going to happen.
He did. Really?
He actually said that the statement that everybody's forgetting the second half of Bloomberg's statement. He basically said, "I'll run as a third-party candidate if it's Sanders versus Trump." Everybody's forgetting that part.
Yeah.
And if you think about it, if you start, and it was funny, he said, beyond media people and brokers, Wall Street brokers who supports Bloomberg. And I'm thinking, dude, you've got a whole slew of Wall Street brokers in the room.
I know.
That was kind of enlightening.
I love the way we all get classified in as Wall Street brokers.
Yeah. But he said that Bloomberg's not going to jump in, but thinking it through, because I got a question about this afterwards, was if think about Sanders, Clinton, and Trump, just throw those three people out there. What type of voter would be most likely to vote for Bloomberg? And it's the Clinton ones.
Yeah.
So if something like that 2% happens to her, then Bloomberg's probably the
Bloomberg or
backup
Biden
guy.
will step in, yeah.
He also did not see much of a chance of there being any sort of brokered convention. He goes, if you're one of the 40% of people that supported Trump up to the convention, and then a bunch of, and these are his words, he kept...
Insider fat cats, was it?
No, he kept saying, a bunch of insider white guys in a back room. Those are his words before I get myself in trouble. But a bunch of insider white guys in a back room steal this thing away from Trump and his supporters, all hell's going to break loose. And that makes sense. So I think the only way that you beat Trump, and I actually looked at the electoral votes, is if everybody drops out except for Cruz or Rubio or somebody like that, and they throw all their delegates to him, at that point we're at a tie right now.
And
so that's...
It's interesting.
Yeah.
And then his final piece was, we are at an area where we are super primed for a real third-party candidate. And then what he said was, I would envision some sort of moderate tech CEO that kind of fits the profile of what normal people think things should work, that has been successful as a tech CEO, starts a real movement around, bringing that same kind of technological approach to politics. He said he was in a J.P. Morgan dinner.
Oh yeah.
Yeah, and he said, Jamie Dimon would be a perfect third-party candidate if he didn't work for J.P. Morgan.
Yeah.
There's no way that would happen in a million
If he didn't
years.
work for J.P. Morgan. He basically said if Jamie Dimon worked for PetSmart, he'd be perfect.
That's exactly what. That was the part he said.
That is
and
funny.
then they bring out the puppy mills.
Yeah.
Because it's always going to be something.
Yeah.
It is funny though. You're right. If there ever was an environment where it's ripe for someone to come out of the weeds. I mean, has there ever been a more relatively light field to contend with? That's why Bloomberg or anyone who has the capital who can do it, it's open.
He noted how split the country is. He cited social media. He also cited our current president. He said, there's nothing that he seems to do that's not trying to divide different groups. And he said, that's why he focuses so much on women's issues, but he's trying to get women to not think about the Republican Party. It's why he focuses so much on immigration, and a lot of his executive orders have really been put out there to do nothing but kind of split up the Republican Party or have them fight amongst themselves.
Split the country, he said.
Split the country,
not even the party. I mean, he was...
Well, that's the ultimate.
Yeah.
That's
it was interesting to see a guy in the political thing basically call President Obama, calculated and... what was it? He used a less than... nothing really like offensive, but he used...
No, he basically said everything that he does is definitely by design, and everything that he is doing is for... He's got all... I'm going to use the Homeland, where they always say that certain people are in it for the long game.
Yeah.
That what he's actually in it for is the long game to try to destroy the Republican Party, and a lot of what he does is geared toward that.
Yeah.
So a seasoned political operator is being a seasoned political operator. That's,
Right.
Imagine that.
That's
Although
surprising.
he said that Trump's amazing in what he does as well. I mean, he was.
Oh yeah,
He said,
he's totally glomming on to what people want.
Yeah. So it was really fascinating. Whether you were a Republican or a Democrat, I mean, he came in with a very, very neutral discussion.
I liked that a lot.
Yeah,
You worry
neutrally.
about
It was
that
not.
sometimes.
You can't be a fire breather.
He was not a fire breather.
He
He talked about Trump because he more because that's the bigger story, and then he did dig in the Democrat, and then some people asked him about where does he think the Senate falls, and he said, that's where the real volatility lies. He goes, there's going to be more often than not we're going to have Democratic president going forward. You're going to more often than not going to have a Republican House of Representatives. Where there's going to be volatility is going to be in the Senate races.
Well, listeners, you can hear probably from the background, they're starting to shut down RMC, so we're going to shut down our coverage here. It's been a fascinating few days. I look forward to digesting all of this in even more detail, maybe having some of these speakers come on the show down the road and kind of get into some of these topics in a little bit more discussion, talking basis points and rolling the VIX and all these other things we're talking about here. Really quick before we wrap up, any other takeaways that you didn't get a chance to talk about, any other things that are top of mind for you guys as we wrap up here our RMC discussion?
No, I just really, I've probably hit on this more than I need to, but just the variety of what we talked about this time, there just were not a couple of common themes. It was all over the place, which I think is kind of indicative of where we are in the markets right now.
That to me was very encouraging, that it wasn't just the same presentation over and over again in different forms. It really was a variety. So no matter how you came here, you're looking for directional stuff, you're looking to do vol, arb, whatever kind of level you were at or whatever you were interested in, straddles before earnings, you had something there that you could really sink your teeth into.
You know what I found fascinating is, you go to most of these conferences, there's, one customer and 50 guys that are either, buy side or sell side, blah, blah, blah. And this is the only conference that I've been to where really there were a lot of pension funds, a lot of assets, by people that engage money managers. There was a lot of money managers. There was a lot of brokers. There was a lot of software development and stuff. There was a lot of education. Really, if you look at all the different pieces that make up the financial puzzle of how it goes from order generation to order completion, everybody was really represented here, and that is really why I like this conference so much. I mean, I split a taxi back from the airport to here with a gentleman who sits on a large insurance's variance desk. And so he's on the buy side. Meanwhile, I'm doing consulting stuff or whatever, or education. I'm kind of product side, sell side, or maybe Carmen Line Capital, I'm buy side too. Who knows? But the mix of people relative to what you get at kind of other conferences, I think, is really really unique in terms of networking.
Definitely unique. Yes, I would definitely. Put it
and I know that's working for CBOE, I know that's by design, but we know because we go to a lot of different events that there are a lot of events where you get invited to speak and then they want you to write a check to go speak.
Yeah.
And that does not happen here. That's not the way that we go about picking the speakers, because of the topics that we want covered and because of their expertise in doing so. And one of the things is if you're on the other side of that, you're going to speak somewhere and they want a check from you, you're going to go and try to sell something because you feel like you got to justify that expense on your end a little bit. So you don't get that from us. I can't think of one salesy pitch type thing that I heard, even in the side conversations. The last 3 days.
Yeah, definitely no one hawking the gold coins or the oil well shares or any of that things you see at a few other events. And with that, listeners, we're going to bring to an end our coverage here of the CBOE Risk Manager Conference. I hope you enjoyed it. We certainly had a lot coming to you, and we'll see you next time for more Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell Indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, Options Insider or via questions@theoptionsinsider.com.